Okay guys, so for today's video, we're going to be going over my top 7 picks for my high yield dividend stocks for 2020. And majority of these stocks that I'm going to go over are in my portfolio. So hopefully that reassures you, because I know there's, articles out there where people talk about certain stocks and then at the end there's this disclaimer where it's like, I own no shares of the stock that I just talked about in detail, which is kind of weird for me. So hopefully, with that being said, that is a little reassuring for you. Also, this is the first time I'm doing something like this, and also, my own disclaimer is that I only started dividend investing like last month. So my prowess and my ability to interpret and give you all of this robust analysis on these stocks isn't going to be like those other stock investors that have been doing this for. So our first stock is going to be Abbvie. The symbol is ABBV, and currently it's at $89.84. I have one share of it, and my total return is just $3.36. So Abbvie is this research pharmaceutical, and it's in the healthcare sector, of course. And it has helped to research and treat diseases, blood cancers, hepatitis, HIV, and it's created this shot called Humira that also treats certain diseases. It's in a whole bunch of different companies like Latin America, Brazil, Italy, the United States, of course, United Kingdom. We go over to Yahoo Finance, which is what I'm going to be utilizing today, along with Seeking Alpha. It has a market cap of 133 billion. If we go over to the financials, you can see that it has been growing in gross profit over time. And that's one of the main things I like to look at just for the basics. So you can see here that since 2015, it has been increasing by the millions, gross profit, and of course by revenue as well. They managed to cut down reduce their costs compared to last year, which is also a good thing. If we go back to the summary, one thing that I like to look at is the earnings per share compared to the forward dividend yield. So you can see here that the earnings per share is $2.18, but the forward dividend yield is $4.72. So usually the earnings per share, as a rule of thumb, should be at least 1.5 times greater than how much dividends the company is paying out annually. So there might be a dividend cut in the future, but I still believe in this company compared to other healthcare sectors like CVS. If they do cut the dividend, then I will have Johnson & Johnson or Pfizer on standby because they pay out a decent dividend percentage. If we go over to Seeking Alpha, which is a great tool to use for dividend investing, and we search up Abbvie. If we go over to dividends, more things that I like to look at to help me choose dividends is the payout ratio. As long as the payout ratio is close to 60, that's good. And a high dividend growth is also a good thing. So the dividend growth has only been for 6 years, which means that it's only been paying out dividends from 6 years ago. I also like to take a look at the dividend growth and see they've been increasing their dividend over time since 2014. And last year it was $3.59. Now it's $4.28. So a big jump. Now this next stock is a little interesting in the sense that I had to decide between this stock and another stock in the similar sector. So we're going to be going over Altria, and the ticker symbol is MO. And it dawned on me recently that it was very similar to a stock that I already have in my portfolio, which is PM Philip Morris. But after looking at the dividend summary on Seeking Alpha, technically, statistically speaking, it has an edge over Philip Morris. But I'm still not sure which one to finally cling on to invest in the long term, because I have both in my portfolio, but I don't want to put too much of my investments into one specific sector. So Altria Group is a company that creates cigarette products, nicotine products, and wine, and it's very similar to Philip Morris, which does the same thing. And they both are trying to get away from products that have a lot of nicotine and are trying to make products that have a lot less nicotine, because they're passing all these FDA laws about restricting nicotine concentration in these products. So let me know down below. Now, I don't condone tobacco use. I don't smoke. I don't do any of that. I'm just looking at these investments as something that I can earn income from and gains from for the future. That's how I'm looking at it. So we're not going to get into any of that. If we go over to Yahoo Finance, we see its market cap is 96 billion. Its EPS is 0.93, but its dividend yield is 3.36. Its dividend yield percentage is 6.57%. Slowly been increasing in revenue, which is always a good sign. I mean profit. Oh, but revenue too, yes. They missed their expectations in Q1 and Q2, but then they made up for it in Q3. And then we'll wait to see what happens in Q4, January 30th, 2020. Now let's take a look at the dividend summary on Seeking Alpha. We know the dividend yield is 6.57%, $3.36 for the annual payout. The payout ratio is 79.74%. The 5-year growth rate is 10.27%. And the dividend growth is 21 years. So it's 4 years off from being a dividend aristocrat. So these are the stats that I was looking at that made me say, you know what, maybe I should go with Altria Group because it is more stable, more reliable. It's been doing this whole dividend thing for much longer than Philip Morris, increasing its dividend more rapidly than Philip Morris as well. Now we're going to take a look at AT&T. AT&T is in the telecommunications sector. You might know them most popularly for their phone service, just like T-Mobile and Sprint. And this one is most loved among the other two by investors because their dividend percentage is, once again, 5.31%. My equity is $78.21. I have 2 shares, and the total return is $2.01, and it's currently priced at $39.11. Now this stock is a little bit iffy, and there's this whole schism between it and Verizon. They both pay out dividends, but everyone is talking about the drawback of having AT&T in your portfolio is that it is spread itself across all these different things like Time Warner Cable, DirecTV, of course, telecommunications, internet service provider, and stuff, and it has accumulated this huge debt. But they have created a plan to pay off this debt, and they met their goal, I think, recently, which was to get it down to 150 million or billion. I don't remember. So they've created this plan to pay off the huge debt, and because of that, everyone has been going to Verizon. But I'm just gonna stay with AT&T because the dividend compared to the price, I'll stay. But just stay tuned and just keep yourself updated with the news. That is what I've been doing. And if anything, just sell it and just go with Verizon. So the dividend yield is 5.31%, as we said. EPS is higher than the dividend yield. The dividend is $2.08 a year. The payout ratio is 58.84%. And I should probably remind you guys that the payout ratio is basically how likely they are to pay out a dividend. Payout ratio is almost at that key 60% percentage that I really do like. They pay out dividends quarterly, and they're going to be paying out a dividend next month. They should be. Their 5-year dividend growth rate is 2.13%, and they've been paying out dividends for 35 years. That is a dividend aristocrat because they've been paying it out for over 3 decades. If we look at the dividend growth, it has been slowly growing up and up and up. Guys, if you made it this far into the video and you're new to investing, create a Robinhood account, but use my referral link in the description. Or if you want to use Webull, you can use that too, and we will both get a free stock for each of those. Next, we are going into the real estate investment trust sector, and we're going to start with Main. I love Main Street Capital. It is a stock that I really want to get into, but I just need more capital. The only reason why I haven't invested into it yet is because I'm already in 3 other REIT stocks. What Main Street Capital does is that they help with refinancing and debt and all that stuff, and they help entrepreneurs and businessmen that are in like the mid-tier growth of their business. I think that's how you word it. Market cap of 2.8 billion. It is still in the billions, even though it is much smaller compared to the other stocks that we went over. Okay, once it comes to the REITs, you can break the earnings per share and the dividend yield rule. So their earnings per share is 1.98, but their dividend yield is 2.46, and once again, 5.67% dividend yield. You look at the financials, they have been growing. However, this time around, their revenue is lower than how it was in the previous 2 years. Actually, the previous 3 years. So they need to make a comeback. Let's see. They have still beat their earnings, though. They recently met their earnings. And now let's see how they do in February 26th. Their payout ratio is 98.87%. So, it's a REIT. You're guaranteed to get your dividends monthly as well. Their growth rate has been 2.94%. Their dividend growth is only 1 year. So let's take a look at the dividend growth. Okay, so there have been slight dividend cuts in 2016 and 2018, but then they brought it back, and it is slightly lower than what it was in 2017, but hopefully there should be growth over time. Their 10-year growth rate is 7.33%, so that's a good sign. Our second REIT in this selection is AGNC Investment. So in short, AGNC Investment is a real estate trust that collects mortgages in the United States, and some of the ways they do that is through collateral. I have 2 shares currently, and my total return is 91 cents. AGNC's market cap is 9.6 billion. Their EPS is actually in the negatives, and their forward and dividend yield is 1.92. Their dividend yield is 10.84%. Now, despite having some negative statistics in terms of dividends, their dividend yield is still pretty high, and it's the highest in this entire group. Their payout ratio is almost 90%, but they still pay out monthly. If we go to dividend growth and take a look, they did cut their dividend in 2014, and it has just been trailing around $2 for the time being. But if you are one of the poor individuals that had invested before 2012, then you might have had to have taken a hit and go for something else. We are winding down now. Next we have is Chevron. What Chevron does is that it develops and produces petroleum, natural gas, crude oil, and it covers the whole process of making it so that people and businesses and other institutions can use that for energy. And it has been growing over time. Very nice growth. And I would definitely be invested in this stock if I wasn't already invested in ExxonMobil. But if anything happens to ExxonMobil, then Chevron is definitely my second go-to. Chevron is another giant company with a market cap of 227 billion. Their EPS is 6.97%, and their forward dividend yield is 4.76%. Even though their dividend yield is only 3.98%, you'll still be getting that $4.76 annually. And this is the first stock in my list that has passed the 1.5 EPS to dividend yield. So that means that they have some money to work with to improve their service. Now, if we take a look at the dividend summary, the payout ratio is 73.96%. You are guaranteed to be getting your dividends from Chevron Corporation. They pay out dividends quarterly, and their 5-year growth rate is 2.81%. Their dividend growth is 18 long years. Let's take a look at their dividend growth. So each year in and year out, they have been gradually growing it. and now it is at $4.76. So you are definitely able to rest easy knowing that even next year in 2020, you'll be getting a higher dividend, and we could actually be getting, it might even be able to break $5 next year. So definitely, I'm considering trading ExxonMobil now for Chevron. But they're two very good stocks, so let me know. What do you guys think? ExxonMobil or Chevron? Comment down below. And last but not least, our final stock in the highest yielding dividends by me is, wait for it, IBM. So let's search it up and pull it up right here. When I think of IBM, I just think of Microsoft. They've created computers, they create artificial intelligence, and they use this and other technologies to help businesses perform their tasks. They also have cloud computing and other things like that. I bought it today because it is actually a dog of the Dow, and I forgot to mention that about Chevron as well. Chevron is also a dog of the Dow, and I think those are the only two dogs of the Dow in my selection for this year. And what that means is that they are among the top 10 of stocks that yielded the highest returns for the year of 2019. And I think they were also dogs of the Dow in 2018 as well. So I was like, why not have at least one of them in my portfolio? So I highly recommend you guys have at least one dog of the Dow in your portfolio, because you're guaranteed to yield high returns from at least one stock. As you search it up, International Business Machines Corporation, what a name. Market cap, once again, 120 billion. Earnings per share is 8.6, and the forward dividend yield is 6.48. So once again, a company that has enough money to, reinvest in itself and create better products for the future, which is very important for a company like this in its sector of technology. So you'll be getting $6.48 a year from just this one stock. If you have two shares, that's $12. And the actual percentage is 4.82%. Now, in terms of earnings, it has just been barely beating expectations. And on the 21st of January, we will listen to the earnings call and see if they can do that again. The payout ratio is at a sweet 50.63%. Its 10-year growth rate is 10.91%. Guys, it doesn't get better. Oh wait, it does get better than this. Their dividend growth is 20 years. Wow. A dividend aristocrat, a 10% 5-year growth rate, a good payout ratio, a dog of the Dow, it's a large company, a 4.78 dividend yield percentage, pays you $1.62 quarterly. IBM. Okay, so in 1992 there was a dividend cut, but we don't care about that because it has made up for that over time. You just had to give it some time, and it has been raising it by around 40 cents each year. Now we are here at $6.43. Been paying it quarterly, 4 times a year, and here we have it. Let's expand this. Look at that. Look at that beauty. Just been going up. It's crazy. We had to save the best for last, guys, and I'm so glad I literally started investing in this. Get that sweet, sweet dividend. Okay, guys, thank you so much for watching. I really hope you enjoyed it. Leave some feedback on how the flow of this video went. Let me know what I can improve on, what other statistics and fundamental analysis I should have done or should have done better. Hopefully next time around I do a video like this, it can be much better for you guys, and I can learn a thing or two that I didn't know from before. So guys, enjoy the rest of your day. Happy holidays. Enjoy your Christmas, Hanukkah, Kwanzaa, or whatever you celebrate. And I'll see you guys around.